Amos Tversky and Daniel Kahneman showed that people care more about losing $100 than gaining $100. Losses hurt roughly twice as much as equivalent gains feel good. This asymmetry, loss aversion, means that rational economic models of human decision-making are fundamentally wrong about basic human psychology. The implications range from stock market crashes to retirement savings to why people keep bad jobs and relationships. Kahneman and Tversky's prospect theory proposes that people do not evaluate outcomes as absolute levels of wealth or well-being. They evaluate them as gains or losses relative to a current reference point. The same outcome feels very different depending on whether you are gaining or losing to get there. A salary reduction from $100,000 to $80,000 feels like a loss of $20,000, painful. An increase from $60,000 to $80,000 feels like a gain of $20,000, pleasant. But in both cases, you have the same absolute income of $80,000. Reference points shape everything. Loss aversion is the empirical finding that losses loom larger than equivalent gains in human decision-making. Kahneman and Tversky estimated the loss aversion coefficient at approximately 2. A loss of $100 is experienced as roughly as negative as a gain of $200 is positive. This asymmetry means people are willing to take on more risk to avoid a certain loss than to secure an equivalent certain gain. Loss aversion explains the endowment effect. People value things more once they own them, because giving them up is experienced as a loss, and the status quo bias, a preference for current states, because change carries loss risk. Prospect theory describes the subjective value function as S-shaped, concave for gains, reflecting diminishing marginal utility. The difference between $0 and $1,000 feels larger than the difference between $1,000 and $2,000, and convex for losses, reflecting diminishing sensitivity to additional losses as they accumulate. This explains why people buy both insurance and lottery tickets. Insurance reflects loss aversion, and lotteries reflect the willingness to seek risk for the small chance of a large gain. The value function is steeper for losses than gains, the visual signature of loss aversion. The planning fallacy is the systematic tendency to underestimate how long tasks will take, how much they will cost, and what risks they involve. Even when people have abundant personal experience with similar tasks taking longer and costing more than planned. The Boston Big Dig was projected to cost $2.6 billion and be completed in 1998. It cost $14.6 billion and was completed in 2007. Outside view correction, deliberately surveying the base rate of similar past projects rather than focusing on the specific details of the current plan, significantly reduces the planning fallacy. The sunk cost fallacy is the tendency to continue an endeavor because of past investment, time, money, or effort already expended, even when future prospects do not justify continuation. The past investment is a sunk cost that cannot be recovered regardless of what you do next. Rational decision-making should be based only on future costs and benefits. Yet people stay in bad relationships because of years already invested, continue failing business ventures because of money already spent, and finish books they hate because they are 3/4 through. The money already spent is gone. The question is only whether continuing is better than stopping going forward. Framing effects demonstrate that the way information is presented systematically influences decisions, even when the objective information is identical. Patients presented with surgery that has a 90% survival rate accept more readily than patients presented with the same surgery having a 10% mortality rate. Ground beef described as 90% lean is rated more favorably than beef described as 10% fat. Loan terms presented as monthly payments feel more affordable than annual totals. Framing reveals that our preferences are not fixed and internally consistent. They are constructed on the fly, influenced by presentation. Richard Thaler and Cass Sunstein's nudge theory applies behavioral economics insights to policy design. Because people strongly prefer default options, reflecting loss aversion and status quo bias, changing defaults can dramatically alter outcomes without restricting choice. Switching organ donation from opt-in to opt-out, where registration is the default, increases donation rates from around 15% to over 90%. Automatically enrolling employees in retirement savings plans rather than requiring active enrollment dramatically increases participation. Nudges work by aligning the architecture of choice with known patterns of human decision-making. Overconfidence bias plays a particularly consequential role in financial markets. Individual investors who believe they have above-average stock-picking ability trade excessively, turning over their portfolios more than necessary, and consistently underperform passive index funds after accounting for trading costs. Overconfident investors underestimate risk, underestimate the probability of catastrophic losses, and overestimate their ability to time markets. These systematic errors aggregate to produce market bubbles, crashes, and the well-documented tendency of retail investors to buy high and sell low, exactly the opposite of rational strategy. Behavioral economics has revealed that human decision-making deviates from classical rational choice in systematic, predictable ways. This is not a counsel of despair. Knowing your cognitive biases, designing better defaults, and deliberately invoking System 2 reasoning all improve decision quality. Tversky and Kahneman's work earned a Nobel Prize in economics precisely because understanding the psychology of judgment is inseparable from understanding economic behavior.